Hello everyone, Kasim Khan is here. Please subscribe my channel and press bell button for more updates. Thank you so much, guys. Today we are going to learn about the financial market and financial environment. This is basically financial system. Financial markets have a big role for the development and long-term growth of the fund because if the financial system is very strong and the markets are very developed, firms will grow because they can easily raise their money for the future investment, for the long-term investment. So if the companies will win the opportunities and they can successfully run their business operation over the longer time, companies will grow because money is very important, for even individual life, for the businesses as well. If there are so many sources of the financing available for the firms, obviously firms will grow over the longer time period. So in this chapter, we will learn about the financial markets and the environment. So here is the financial institutions and the market firms that require funds from external sources can obtain them in three ways. So there are the three ways through which firms can do external financing. In here, a little bit give a difference between external financing and internal financing. Internal financing is the source of internal resources of the firms like profitability, earnings. The company earn the money over the time period with the business operation that's comes under the internal financing, and external sources are like debt financing and other equity financing. The company raised their money from open market for their long-term projects. So there are the three ways through which companies can finance their external sources. The one is the financial institution. Through financial institutions are your like banks, commercial banks, your insurance companies, mutual funds, all these kinds of the institutions and the intermediaries who lend, who give the money to the company that's come under the financial institutions. So through financial market are your capital markets, money markets, and your stock market who give the equity financing, who provide equity financing to the companies for longer projects. So through private placement, through there are so many business relation with the direct investors, suppliers of the funds. So the company have a direct relation with some bodies, with some investors. So sometimes companies fulfill their financing needs with through private placement, through with direct relation. That comes under the private placement. So first here we will discuss about the financial institutions. What are the financial institutions and what are their role in the financial system and financial environment? So, financial institutions are basically intermediaries that channel, that basically flow the savings of individual businesses and the governments into the loans or investment. There are two sectors exist in the general society. The one side is the people who have a surplus of money, but they have no like some kinds of business ideas. They have just surplus of money, and the other side is the that are the bunch of people or the bunch of organizations who have some good ideas. They have some good business plan, but they have no money. They have a shortage of funds. So basically, intermediaries are the institution who takes money as a deposit, as a saving from the surplus side, and the other side is the governments, businesses, firms, individuals who have some kind of good ideas, good business plan, but they have a shortage of money. So the financial intermediate institution provide to the money to them. Basically, the financial intermediaries channel the funds. They flow the funds from one side, from surplus, to the other side who have a shortage of funds. So the key suppliers and demanders of funds are individual businessmen and the governments. Obviously, businesses require the money for long-term investment, for long-term projects, because on the basis of long-term projects, the company growth based. So for the governments, because governments need a money to invest on the public project, so government also needs money for the long-term projects. In general, individual are net supplier of the funds, like general public, like we are in the society. So we are the suppliers of the funds, while business and the governments are the net demanders of the funds because they have a shortage of funds, so they need a money. So commercial banks are the institution that provides savers with a secure place to invest their funds, and that offer loans to individual and business borrowers. So commercial banks basically do a two activities. They facilitate the surplus sector with the deposits. They take money as a deposit, and they lend money to the borrower who needs funds for the business operation. So what are the investments banks? Investments bank are very important in channeling the funds in financial system. Investments banks are the institution that assist, that support, that assist companies in raising capital, advise firms on a major transaction such as merger or financial restructuring, and engage in trading and market making activities. Investments have a big role, especially in the companies who like transform from private to the public companies. The companies need money. Raising capital. What is raising capital? Basically, when the companies transform from private to the public, they issue share that is called IPOs, initial public offering. So, because most of the time companies are not well renowned in the market and their shares are not well accepted and appreciated in the market, so investment bank help to the companies to sell the share to raise the capital in the market. So that is called basically raising capital. Advice firms on major transactions such as merger. Merger is also big deals, and that is also a very important step. And the firms need to reconsider so many things when they do a merger kind of activities. They also give us services. They help in like financial services, financial analysis to the company how you can take these decisions. So financial restructuring, most of the times companies change their like mix of financing, like how much they need to take a change in debt to equity financing structure. So that is called financial restructuring. So investment bank also facilitate to the company in this as well. Engage in trading. Trading is now nowadays a very big business in the finance in the capital market, like share trading and secondly currency trading, because most of the time companies are multinational corporation and they need to return back the profit into the parent company. So they need to transfer their currency, the local currency, to international currencies like dollar, pound, etc. So they need some kind of trading activity. So investment banks also facilitate firms in trading as well. And there are so many market activities like which generates liquidity and investment opportunities for the companies as well. Investment banks also facilitate to the companies in that as well. So the other one is financial market. What that is the second source of external financing for the firms. What is financial market? Financial market are the forums in which supplier of funds and demanders of funds can transact business directly. So here is no intermediaries involved, no like financial institutions. There you can directly. This is the basically marketplace. This is the forum where supplier of fund and demander of funds can directly interact, and they can exchange the funds. Transaction in short-term marketable securities take place in the money market, while transaction in the long-term securities that take place in the capital market. There are two kinds of the market. One is the money market, the other one is the capital markets. If the security maturity time period is less than 1 year, less than 12 months, that security will transact in the money market. And the securities who have a more than 1 year maturity time period, who have a maturity time period more than 1 year, more than 365 days, that securities will be tradable in the capital market. So, what is the private placement? That is the third form and a source of external financing. A private placement involves the sale of a new security directly to an investor or a group of investors. When the businesses expand at larger level, they earn a very good name in the market, and that companies are very renowned in general public. So at that time, there are so many investors, so many institutions, and the businessmen are directly interested to do the business transaction and the business adjustment. So when the company sell their new security directly to the investor in a group of investors, that is called a private placement. We can take an example of PTCL, Pakistan Telecommunication Authority. Limited, Pakistan Telecommunication Limited, that is a very renowned and Pakistan government state-owned based company that have directly sold out their shares to the Etisalat. Etisalat is a UAE company. So their 49% of PTCL share directly sold to the Etisalat. This is basically a private placement in which you just sell your all share, one group of investor, one individual, one company. That is called a private placement. Most of the firm, however, raise money through a public offering of securities, which is the sale of either bonds or the stock to the general public. So this is the common way, and most of the time, 95% this method has been adopted by the companies in the market. They just sell their shares to the general public because they don't want to give a maximum part of the ownership to the one group, because there are so many limitations when you give a major bunch of your securities to the one investor. Obviously, they most of the time they influence on your decision making, and they can impact your business operation and future plan as well. So private placement is not as much likely as much the public offering of the security is accepted in the market. So there are also some other two types of the market. The one is the primary market, and the other one is secondary market. The primary market is the financial market in which securities are initially issued, the only market in which the issuer is directly involved in the transaction. When the security has been issued first time, that is called that security will be tradable, saleable in the primary market. That because in that transaction, the actual issuer of the security directly sale to the client customer first time. The first sale of the security is done in primary market, and that is the directly sale of issuer to the buyer. Let's suppose Coca-Cola has been issued the 1,000 securities in the general market, and when security will be tradable from company, will be sold from company to Mr. A, that is called that sale is called under the primary market. What is the secondary market? Secondary market is your pre-owned securities. These are basically in which the direct issuer is not involved, which is already trade in the market. Other secondary market are the financial markets in which pre-owned securities, those that are not new issues, are traded. This is basically a used security has been traded in the secondary market. And what is the benefit of the secondary market? Because most of the time, students ask, listener ask, what is the benefit? Because issuer is not directly taking the money in the secondary market, but with the passage of time, securities prices has been changed and they are increasing with the more trading. So what the benefit get will get to the firms? Obviously, let's suppose Coca-Cola issued their security as at 100 rupees, a $100 first time, and with the passage of time, their security has been traded, and that security change the many hands. And after that 1 year, that security is trading at, let's suppose, $150. So at that time, what the benefit will get the Coca-Cola? If at that time Coca-Cola will issue the new securities, then Coca-Cola will issue not at $100. Coca-Cola will issue new securities at $150, because in the market, current market, their security is trading at $150. So with the passage of time, obviously, if the company will take a good decision, their securities prices will increase. And if the secondary market for company security is very good, then company can issue their new securities on higher price. So that's why secondary markets are very important for the company as well, because new issuance will be done on the basis of secondary market price. So here is a chart that is very important. Here is the on the left hand, there is a supplier of the fund. These are those people who these are those individual and the people who have surplus of money, surplus of fund. On this side, there are the demander of fund. These are those people and the individual and the organization who have a shortage of funds. They have good plans, they have a good business opportunities, but they have a shortage of money. Those who have a need of money. Here is the financial institutions like commercial bank, financial insurance companies, financial institutions, and you can say that mutual funds, brokerage firms. Here are the financial market like money market and the capital markets. These both institutions almost have a same function. They just like give a flow, channel the funds from one sector to the other sector. Here is the direct placement. Here is no intermediaries involved in this system. A supplier directly meet with the demander of the firm. There is no involvement of the institution. But in other two channel, financial institutions and the financial market, there are a direct, there is an intermediary involved. And these institutions are responsible to give back the deposit to the supplier of funds, and they are responsible to take a money back from the demander of the fund. But in private placement, no institution is responsible sure, for your money. So from we take start from here. It's from supplier of funds. This money will flow from here to give go in financial institution, then flow to the demander of the firm. So this way it will flow back to the again supplier of fund. So this way this money flow among the depositor and the supplier. So like money will flow from here funds, that money will deposit by the financial institution, then this money will be lent to the demander of the firm, then this demander of fund will give back money to the financial institution, and financial institution will give back the money to the depositor. Same like as the financial market, supplier of funds will invest in the financial market give money to the demander of the firm, then demander of the money will give back their money to the financial institutions and financial market, and financial markets give money back to the supplier of fund. So this way, the flow of funds of our financial institutions and market work in the real life. So, what is the money market? The money market is created by the financial relationship between supplier and demander of the short-term fund. Money markets basically trade those securities which have a maturity time period less than 1 year, and these are basically short-term securities like you can say that T-bills, your notes securities. Yeah, you can say that your commercial paper also comes under the market. Most money market transactions are made in marketable securities, which are short-term debt instruments such as US T-bills, commercial paper, and negotiable certificates of deposit issued by government, business, and the financial institution, respectively. All all kinds of securities. It doesn't matter which institutions, which body has issued these securities. All those securities which have a less than 1 year maturity time period that are traded under the money market. Investors generally consider marketable securities to be among the least risky investment available. Obviously, although in these kind of securities they have a less return, but the risk is very low. Default risk is very low, and most of the time, a risk-averse investor like to invest in this kind of securities. So, what are the capital market? The capital market is a market that enables suppliers and demanders of long-term funds to make a transaction. Obviously, most of the projects of the companies are the long-term projects, and the companies need long-term financing to fund that project. So, most of the time, companies like to do financing from the capital markets because the default risk is very low for the borrower in capital market. The key capital market securities are the bonds, long-term debt, and the both both common and preferred stock equities are the ownership. What are the bonds? Bonds are basically long-term debt instruments in which you give interest payments. The interest payments are fixed. They are that are not changed with the time. Bonds are the long-term debt instruments used by the businesses and the governments to raise a large sum of money, generally from a diverse group of lenders. Obviously, there are so many bodies, the institutions, lender who give the issue the money, these kind of instruments. So the bonds are the big and the long-term debt instruments and the source of money for the fund. What are common stock? Common stocks are the units of ownership in trust or equity in a corporation. Obviously, common stocks are your shares which give ownership right to the investor, and they become owner of the company, and they are likely will take dividend in future of the company, and they will also be like owner of the raising capital as well. What are the preferred stock? Preferred stock is also known as the hybrid securities, hybrid stock, which carry the both characteristic of bonds and the common stock as well. Is a special form of ownership that has feature of both bond and a common stock as well. So it carry the characteristic of the both bonds and the common stock securities as well. So, what is the broker market? Broker markets are the securities. Here we will discuss about the broker markets and the dealer markets. That is very renowned in trading, and most of the time you also be deal with these kinds of market in real life as well. Broker markets are securities exchange on which the two sides of transaction, the buyer and the seller, are brought together to the trade securities. Basically, trading takes place on a centralized trading floor, like example of New York Euronext, American Stock Exchange, New York Stock Exchange, Nasdaq Stock Exchange. So basically, broker markets are the a platform, and that is a physical marketplace where they can give a trading opportunities to buyer and seller as well. Both parties are there, and they are directly exchange their funds on the market at that marketplace on that market forum. So, what is the dealer markets? Dealer markets are market in which the buyer and seller are not brought together directly, but instead have their order executed by securities dealer that make markets in the given security. The dealer market has a no centralized trading floor. That is very important. They are just directly and directly like connected with each other on like with with the mass telecommunication. They have no physical trading floor. Instead, it is made up of large number of market maker who are linked together via a mass telecommunication network like a Nasdaq stock exchange. You can say that Forex and so many other stock exchanges in which you are directly like connected through some kind of dealer, and you do a trading like all kind of online shares and buyer trading, that comes under the dealer market. As compensation for executing order, market makers make a money on the spread, bid price, and ask price. This concept is very important. What is the bid price and what is the ask price? Bid price. Let's suppose I have a security of Coca-Cola and I want to sell out. Let's suppose the actual value of security is 100 rupees, $100, sorry. And if I visit the some broker market, sorry, dealer market, and I want to sell it, and the price dealer will offer me on that security, that is called bid price, the a price on which he is willing to purchase my price, that is called bid price. What is the ask price? Ask price is the price the dealer is willing to sell the security to me, that is called ask price. Let's suppose if I am a buyer of a Coca-Cola security, and he will say I will sell out you, let's put at $100, $105, that is called ask price. And if he is willing to purchase same security from me at 102 price, that is called bid price. And the difference between bid and ask price, that is called spread, and the spread is the profit of the dealer. So basically, a bid price is the price the dealer offer you on your security, on your commodity, that is called bid price. And the ask price, the price dealer offer you for the sale of security, that is called ask price. So what are the some are very renowned: international capital market, Eurobond market, foreign bond market, international equity market. These are the basically big markets where are the sellers of the securities are be available, and they are like issue to the securities as well. And what is the role of capital market? That is very important concept, because without capital markets, there are it is very difficult for organization to do long term investment, because not any organization is enough matured, and they have not enough internal resources available so to manage their long term investment. Every organization, even every profitable organization, needs some kind of external financing to win the long term opportunities for the business success. So capital markets are very important for fundraising, for long-term financing, for long-term opportunities, for long-term investments. So from firm perspective, the role of capital market is to be a liquid market where firms can interact with the investor in order to obtain valuable external financing resources. From investor perspective, the role of capital market is to be an efficient market that allocates funds to their most productive uses. An efficient market allocates funds to their most productive uses as a result of competition among wealth maximizing investors and determines and publicizes prices that are believed to be close to their true value. So today we see a big organization like multinational corporation Coca-Cola, Facebook, Boeing, and KFC, McDonald. All these are these are those companies who are operating more than one country, 100 countries. So they have a big kind of like capitals, assets. They are just because of due to capital markets. They have like financed their companies capital from the capital markets. It's all due to the capital markets and strong financial system. If the financial system and the capital markets not exist, we can't see a big companies in the real life. So here is the role of market that just tell about basically this is the big facilitation for the funds creation of the for the firms. So that is the business expenses, business taxes. That is a very important concept in the financial system and the financial environment. So we will discuss this concept in the part two of the video. And if you are interested to know more about the business taxes, you see the part two video. And thank you so much for watching. Take care, stay happy, stay blessed.